Welcome to Stock Talk with Nico Kritikos. Today, we're going to be doing some stock analysis on Cbrl, otherwise known as Cracker Barrel. And this is a stock that I purchased recently, a couple days ago, at $97 a share, as we can see right here. And after doing some more analysis into the stock today, I realized that it may not go up as high as I thought it would. So if I was going to sell it anytime soon, it wouldn't be because I think it's a bad investment or it doesn't have upside. It's just because I found something else that has more upside. But as of now, I'm going to hold this. I'm really happy with this company and with the valuation I got it at, as well as the dividend. And so I'm going to go through all the different points. We're going to look at my checklist right here that I made and go through all the pros and cons, as well as compare it to its competitors. So number one on the list we have is the stock down. And yes, as you can see here, both on the 1-year chart and the 5-year chart, the stock is trading much cheaper than where it normally trades. Number two is going to be revenue and net income. If we look at those numbers, which we should be able to find right, let's see, we can look at it here. So what happened with the revenue and net income was pretty much revenue. This year we had record revenues. And however, profit margin and net income is not where it was. There's a lot of companies dealing with inflation problems and supply chain problems. That's still a ongoing thing. So that's why they have not reached the net income that they had back in 2017 and 2019. But I'm fairly confident they will get back to those levels some point, either in 2023 or 2024. But at the same time, ever since the pandemic, over the last 3 years or so, they have improved their revenue and their net income. So it's not like they're doing that bad of a job. And then prior to the pandemic, they were also, so that's why I gave both of those a yes. Then we get to the PE ratio. And what we can see here is that the PE ratio normally trades around a 13, maybe a 14, right? If it comes down to cheaply, it comes up to the 16 level as well, but range. And so if we go to what they're going to do for EPS, this year, it's expected to be about $6.50. So, or $6.30. So that means the stock should be valued at $88 a share, roughly this year. But for the following year, their EPS is $7.50, which means the stock would be $105. And as you can see, the stock price is not too far away from those prices. So there's not a ton of upside, right? But the thing to take into consideration is that the stock in prior years, 2015 to 2019, or really up to 2020, the stock was trading at $160 to $180, or really $150 to $180 a share. But that was with EPS up to $10. So you can almost think of it like if the stock is going, if the stock hits $180 and they peaked at $10 of EPS, that means it's roughly 18 times. The valuation's 18 times what they will do in EPS, which means if that's true, then 7.5 times 18 means the stock should be $135 next year. So that's another way to look at it. But I'm confident it'll come back to this level of around $160, and they will get back to that EPS level of about $10, or even really $9 plus would be good. Then if we look at, let's see, are they innovative? Well, this isn't really what I think of when I think of an innovative company, but I guess you could, or their moat, really, I guess you could say they have that gift shop connected to the restaurant, which is pretty unique. And they also have a certain type of style and just the way the place looks, the way it's decorated and stuff that is very unique to where there's not really any, there's the other restaurants don't really have that type of style that they have. So there is something unique about their business and their image. Is the industry growing? Yes, I think people are always we're gonna have more people, and we're gonna have more people eating more food. So that's not really a problem. How is the return on invested capital? It's very strong. I also compared it to Texas Roadhouse, and I compared it to Darden restaurants, and all of them had C. So we're looking for, where is it? Not this. Oh, no, this is it right here. So it's normally right around these levels of 25%, which is super strong. That's a very good number. And you can see in 2021, it actually went all the way to 45%. I think they made a big investment in late 2020, and that skyrocketed their the money they made temporarily. But even before, you can see it went up to 30%. So we're really happy with those numbers. Those are definitely respectable. Same exact story for margins. It's very similar to their competitors, and these numbers aren't amazing margins, but for a restaurant, this is what you can expect. It pretty much hovers right around 6 to 7%, and that's just how the restaurant business is for a lot of times. So it is what it is, but it's obviously works for the restaurants that do it the right way. Healthy cash flow, I put yes. This one could be debatable because it's kind of volatile, and also you got to think from 2019 to now with the data that we have here. Those years were very volatile for, a business like this. So you have to kind of expect that. But the bottom line is they have positive free cash, besides for the pandemic year, they have positive free cash flow, and operating cash flows are staying strong. It was $360 million and now it's only 200 million. But again, they're still recovering from the pandemic, I think. And I think it'll get back above 300 million, and then end cash position 45 million. So these numbers aren't the best, but they're also not the worst. It's not like they're in a dangerous position necessarily. Do they have diverse revenue streams? Well, again, they have that gift shop, which is something different, and most restaurants are not making money that way, so that's something. But I guess they have lots of different locations. Let's see, how many locations do they have? So that one could go either way too. You could say it's not very diversified, or they only really have one way to make money. But that's kind of, it's debatable. Well, I'm not finding how many locations they have. Oh, 664. Okay, so not a ton, really. That's not a ton. So really, with that you could look at that as they have room to grow, right? More assets and liabilities. This is always important to look at. On the balance sheet, we can see here that they do have positive equity, and it's about $500,000. So not too bad. Not as good as where it was, but I think they'll get. This isn't like a risky, this isn't like a risky business model. We're not dealing with like a new tech startup. This is just a restaurant that's been around for 50 years or 40 years. Is the equity over 10% of the market cap? Yes. $500,000 or $500 million of equity with a little over a $2 billion market cap. So it's about 20 something percent of the market cap. Number 13, this is one of my favorite ones. Is the share count decreasing? Yes. Not by a lot, but that's okay, because as long as it's not diluting shareholders, then we are good. So that's going to get a check. Are insiders interested? No, this is the only one that didn't pass. Unfortunately, insiders own less than 2% of the shares. And when you go ahead and check over the last 2 years, the insiders have not been buying or selling the stock much. The only thing I found was one insider sold the stock at $117 some point in the past, but that was the only one. So they're not very interested. Next up, is the management respectable? Yes. The CEO, she has lots of experience. She's worked with multiple different companies, and I think she's on the board of directors at Lowe's. And she's been running the company since 2011. So I'm fairly happy with the management team. I mean, if they can put up those ROIC numbers that they do, then that's good. Do they have more current assets than average earnings? Yes. Current assets, 317 million. And this prior year, they did a little over 100 million in earnings. But before the pandemic, they were doing, 250 to $300 million of earnings. And their current assets sit above that. So that's what I like to see. Do they have a healthy dividend? Yes. Now, so their dividend is about 5.4%, as you can see here. And although the payout ratio says 100%, it looks bad. It's actually not that bad, because so they're going to be paying out $5.3 of EPS this year in dividends. Well, they're going to do over $6 of EPS this year. And then the following year, they're going to do over $7 of EPS. And then eventually, years down the road, they're going to get back to that $9 to $10 range of EPS. So $5 is nothing to be too much worried about. And finally, is it over 20 years old? Yes. I believe the company was founded in 1969. 9. So all in all, we have a score of 17 out of 18. So that's the reason I purchased this stock. But again, I'm really looking forward to collecting that dividend income on this one. And it'll just by looking at the stock chart, you can see that I bought it at a pretty low price. And the only thing here is that the upside does look fairly limited for the foreseeable future. So if I was to find a better opportunity, there's a chance that I move this money into another stock. But that, of course, that does not mean that this is a bad investment. So that is all I have for you today. Thank you for watching. I will see you in the next video.